Thank you so much for watching, and before we forget, guys, if you like the channel, make sure that you click on the subscribe button. That way you can get all the updates, all the free videos, and all the free resources that I give out to my subscribers. ERV or the TDC of the single unit, these costs are actually per unit. So all you do is you have to just copy 25350 and you've got your interest cost. I couldn't incorporate that here because it was actually converting it into a circular loop. So your total development costs for the project are coming to $612,000, and the profit is $37,000 per unit. Now you've got a development margin of 6%. Now who in their right mind would do a deal like that? Nobody. So you've got to make sure that it seems that everything else in here, because you can't build them any smaller, so what you got to do is, the first thing you got to do is go and find out whether or not you actually, this could be a deal that you already got plans and permits for. So maybe do you want to build them 20 squares? I don't know, maybe can you get away with 18 squares? So that brings the cost down, and it actually gives you a good margin on your profit, because everything else is actually going to remain the same. And I'll cover what does the G stand for, and how is the GST calculated in a second. But understand this, that you're making 63,000, right, and per townhouse. So your total project revenue is 254,512 cents. Now you've got a target development margin. You say there's no way that if all the other costs and inputs that you've actually put in are correct, or at least they are in a good ballpark figure, you should be saying to yourself, I want to make at least 15% development margin on this deal. So if you type 15 where target development margin is DM, look what it does. It brings down the residual value of land to 217 as opposed to 238,500. So what it's telling me is that you should pay no more than $869,381.86 if you want to make a development margin of 15%. So that's the major thing that you gotta have in at any 2-minute feature, because you can quickly say, nah mate, I'm gonna stick to my guns. I have to make 20% development margin on any deal I do. Put in 20% here and it'll tell you what you should be paying for land. So I haven't actually come across anything that can do that for me in any of the courses that I've done, or in any of the mentoring programs I've done. Nobody actually told me that, and if I just wish that they would have, because that just takes a lot of pain and a lot of guesswork out of me. It just becomes pure numbers. Also, if you've got these numbers right, and trust me, I think 6 months into the course, if you're doing the course and you're analyzing deals every day, you're bouncing off ideas, you should be able to do this 2-minute FISO on 20 projects in a day and figure out what's available, what's not available. And when you are doing all this research, you reach a point where you look at a deal and all these numbers will start coming to you. It doesn't matter if you're not a numbers person. Don't believe that, because you've actually told yourself that from I don't know, ever since you were a kid. You've actually taught yourself that, oh no, I'm no good at numbers. So don't say that, because you've got a blue, yellow, as good as black and white financial feasibility template that you can use, punch in numbers, and you know how to make a decision. So always remember that. Look what happens if I change that to $1 million for land, and my development margin's gone down below 10%. I would be very wary of this deal. So make sure that you can play around with these numbers, you can tweak them, and you understand what the financial outcome for you is going to be. Okay, now let me explain how GST is calculated. See, over here you've got GST as margin scheme. Margin scheme is basically you have to get in touch with your accountant and they can explain it to you much better. I do explain that in my course in a lot more detail. What margin scheme is margin scheme is basically you paying GST on the value that you added to land, not on everything else. So it's got a formula, and that's already incorporated in this GST over here. Everything you see that says G against construction, consultants, marketing, miscellaneous, that's because these are the expenses that include GST. So any GST that you spend on them, on construction, on consultants, in a property development balance sheet, when you do your BAS for your development entity, you are allowed to claim these input tax credits. You can get them back. So all this calculation is actually based on all this money coming back, but then you got to pay GST when you sell your townhouses. So it actually automatically does that hidden somewhere in the sheet, which you can't get to. So don't worry about how that's happened. Just remember whether or not GST margin scheme applies to you. If it doesn't, just press the delete button and it's gone, and you know that the GST liability is going to be a little bit higher. But see how it's not exact 10%? The reason for that is GST, you claim all the GST that you pay on expenses, but then you return all the GST that you've actually collected on revenue. So this is basically, and whatever the difference is, you either pay or you keep, or you claim back from the taxation office. So this actually all GST is calculated in the background. So if I was to put margin scheme and say yes, margin scheme, just put a Y. If you put yes, it does nothing, won't do anything. Just make sure that you just put Y for yes, and it'll pick up and it'll calculate and tell you what the GST liability should be, and so that GST is added as an expense and becomes part of the total development cost, so that the profit is calculated nice and clean. So let's say you're making 13.28. If I say my target development margin should be 13.28, look at what you should be paying, $901,011 something. Look at here what you are paying now, 901. So this is based on all the different costs. It takes off all the different costs and revenues and so on. So there's a formula to calculate the residual value of land based on development margin. Now don't confuse, there are different ways to calculate residual value of land. This 2-minute FISO only does that via development margin, so that I know that for me and the project and the kind of projects that I'm doing, this is more than enough. All I want to know is that how much should I be paying for land to make sure that I make at least 15% development margin. Bang, I can't afford to pay more than $867,000. So, and I make 15% on it. So make sure that you do that. Over here you're paying, now this price, this 867 actually includes the stamp duty and all your acquisition costs. So it's actually comparing that with $901,000 with 866. So make sure that you're not paying $35,000 too much. So always do this 2-minute FISO, and I hope you make the most of this calculator. If you've got any questions, shoot them to support@propertydevelopmentsystem.com.au, or if you've got a comment section below, leave a comment there. I will go through it and I will reply to it. Thanks for watching the video. All links are actually in the description. If you would like to download a free resource, which is the free property development blueprint, you can do so from my website by clicking on free blueprint, and you should be able to download everything. So make sure you check out propertydevelopmentsystem.com.au, and also the links in the description below. I'll see you next time.